Hey everyone, welcome back to the channel. As you all know, continuously learning is probably the most important factor in the game of investing. And in this video series, I'd like to cover my monthly favorite resources that I have used to learn something about investing. So in this video, I'll give my key takeaways from an investing book, a podcast, and an investment write-up that I found really useful in the month of January. As always, if you've found anything very insightful in the past month, feel free to share a link in the comments below. Okay, let's hop into my monthly favorites. For a book that I really enjoyed this month, that would be Warren Buffett, Inside the Ultimate Money Mind. This is written by Robert Hagstrom, who has written some of the most important books, in my opinion, on Warren Buffett, including the Warren Buffett Portfolio, the Warren Buffett Way, and Investing as the Last Liberal Art. This book is sort of a combination of all of his past works with some new information as well. It starts off with an early biography of Warren Buffett's life, including growing up in Omaha and going to Columbia to actually learn value investing. We then travel on down the road to some of the key inputs for developing Buffett's investment philosophy and some of the key men in his life, such as his father, Howard Buffett, Benjamin Graham, of course, and none other than Charlie Munger, and the impact that all three of these men had on his investment philosophy. Probably my favorite chapter in the book is the one titled The Evolution of Value Investing. And well, as the self-explanatory title indicates, it chronicles how value investing has evolved since the early days of Benjamin Graham, who is considered the father of value investing, all the way until today. So it starts with stage one, which is basically the deep value Graham style investing, where we're taking quantitative factors, finding a bunch of stocks that are trading for less than their net asset value, and buying those companies with no regard for the future value of those companies, other than the fact that these low prices may revert to the mean, even if the future prospects of the business are not very good. The second stage is more along the lines of what Charlie Munger helped influence Warren Buffett into, and Phil Fisher, which is thinking about the actual quality of the underlying business of the stock that you are buying. So stage two includes all of the underlying ideas that Graham preached, such as investing with a margin of safety and understanding that the shares you're buying are actually ownership stakes in a real business. But we're then discounting the future cash flows back to the present in order to arrive at some value, not just looking at the hard assets on the books. I want to read this quick passage, which is an idea from Tom Gaynor, who's the CEO of Markel. He said that there's a difference between classic Graham style value investing and stage two investing. It's the difference between a snapshot, which freezes one specific moment, and a full-length movie, which unfolds over time. Stage three was the one I was most excited about, which was the value of network economics. Now, you've got to read this section for yourself if you do decide to pick up this book, which I would recommend. But it actually views this stage through the lens of Bill Miller's investment journey. Miller was famous for investing in high-flying companies like Dell Computers that were selling for really high price-to-earnings ratios, but had extremely high returns on equity and returns on their reinvested capital. So overall, this is a really great book. It covers the topic of what a money mind is, which I may cover further in another video, but it's basically somebody who is wired correctly to do this whole investing thing. It's somebody who's rational, who is self-reliant, somebody who understands that investing is about thinking like a business owner, someone who is potentially a contrarian or a nonconformist. There are a lot of attributes, and really, Warren Buffett is the epitome of all of these ideas. So definitely check this one out. Highly recommended it. It's a fairly quick read, but very insightful. It mixes a lot of philosophy and investing ideas, which is really nice. The podcast that I really enjoyed this month was an interview between Shane Parrish, who runs the Farnham Street blog and podcast with the Knowledge Project, and Marc Andreessen, who is the co-founder and general partner at Andreessen Horowitz, which is one of the most, if not the most successful venture capital firm in Silicon Valley. Andreessen has invested in such behemoths as Twitter, Pinterest, and Facebook, just to name a few. And for those of you who aren't familiar with Shane Parrish, the Knowledge Project is one of the best resources for a multidisciplinary approach to learning and applying those ideas to investing. This podcast covers a wide range of topics, as one might expect from a venture capitalist, from what are some optimistic and pessimistic views of the future, some commentary on the education system, and even a historical frame of reference for how societies have historically reacted and interacted to new technologies as they appear. And surprisingly, the past does sort of predict the future. My main takeaways from this interview were how Andreessen thinks about the probabilistic nature of venture capital and investing in general, and how he uses figures like Elon Musk and Peter Thiel to create mental models to keep his decision-making in check. Touching on the probabilistic nature of venture capital, the game of venture capital is slightly different from what a lot of the public equity investors that I admire do, such as Monish Pabrai, Warren Buffett, and guys like that. They run very concentrated portfolios, and they make very few bets. The way that venture capital in general, and specifically Andreessen Horowitz, operates is a little bit different than these concentrated portfolio type bets. Say an investor at the VC firm makes 10 bets. All of these 10 bets could be in a similar industry, and the nature of that business is that there's a high probability that 9 out of 10 of these bets will fail. But the result should be completely judged on the overall return for all of those bets, not based on an individual case-by-case investment basis. So going 1 for 10 is perfectly acceptable in VC if that one makes up for all of the other losses in the portfolio. One of the examples that Andreessen specifically gave is that they've made about 10 bets across the gaming space, because that's one of the industries where they think that they're going to be able to make money in the future. So they've made 10 bets, and hopefully the goal is for at least one of those to work out and be so successful that it's going to trounce all the losses. So imagine investing in an early stage company like Facebook, for example. The returns from Facebook probably could carry that entire portfolio for maybe the rest of its existence, depending on how well 1 or 2 bets performs throughout the lifetime of the fund. Sir John Templeton has said that even the best investors are going to be wrong 1/3 of the time, and that error rate is a lot higher in the VC world. And because of the probabilistic nature of the field of investing, not just VC, but also public equity investing as well, all of our bets are made on probabilities. There's no 100% sure bets, and anything can happen truly. Now, we can make educated guesses, and that's what, in both the case of investing in public companies like Berkshire Hathaway or investing in companies that are private that potentially could be the next Facebook. The bottom line is that investing is a game of probabilities, and the number one rule of that game is to not go broke. And venture capitalists achieve this in a somewhat different way than public equity investors do. But at the end of the day, the goal is to make a high probability bet and potentially take a risk that could lead to a huge reward in the future. At the end of the day, the way that this affects decision making is that in a probabilistic world, you have to make a decision with incomplete knowledge. As long as you're not going to go broke from any one bet, the probabilistic world of games like investing allow for massive asymmetrical risk-reward profiles of opportunities that you really can't find in many other fields. It was interesting to learn how VCs operate with many bets compared to especially what I'm used to doing in my portfolio. But at the end of the day, I think the environment is the same. It is a probabilistic environment that hopefully provides a lot of asymmetric reward on the upside and limited downside. The way that VCs limit the downside is by making a lot of smaller bets with the hope that one high flyer, high performer is going to make up for all the losses in the portfolio. And in a concentrated portfolio, I'm trying to make a few high probability bets with an asymmetric risk profile as well. So in that regard, it is quite similar to the VC approach. The other takeaway I had from this podcast was Andreessen's mental model of using some of his heroes and people he looks up to, and even his friends like Elon Musk and Peter Thiel, to help him with his decision making in life and in business. So say Andreessen is thinking of investing in a new company. He's trying to formulate, the investment thesis. Should I invest or not? He might imagine Elon Musk sitting on one shoulder. And this is great because Elon Musk is somebody that Andreessen really looks up to and admires and would love to get his opinion on this matter. Basically, this gives him some intellectual bumpers, some guardrails for thinking about problems. He's basically asking, what would Elon do in this situation with this investment? Have I thought this out thoroughly enough to explain it to Elon? And would he laugh in my face? Would he tell me to go back to the drawing board? What is it that I don't know about this investment that I could improve and bring it to my partners? So in this way, if we consider that we're talking to Elon, of course, we need to know how Elon Musk thinks. And one of his key mental models is first principles thinking. That's basically not assuming anything. We try to reconstruct the logical progression of things from the ground up, and that's sort of a physics concept. So it's almost like using an individual to hang his mental models on. So maybe he thinks, okay, I need to approach this from first principles thinking, and the trigger for that in his head is thinking about his friend Elon Musk. This is something that I personally try to do when I'm making investment decisions. One of the questions I'll ask is, what would Charlie do in this situation? Talking about Charlie Munger. Would he touch this investment at any point in his career when he was a small-time investor all the way up until where he sits today? I find that filters out a lot of investment ideas. Not that I know exactly what Charlie would do in a certain situation, but if there's some sort of something that isn't adding up and I ask that simple question, then usually the answer is pretty obvious, and that would probably be to pass on it, because Charlie and Warren Buffett pass on almost every investment opportunity. And even Charlie, I'm sure, has used this mental model in the past. He is a huge admirer of Benjamin Franklin, and I'm sure he's imagined talking to Benjamin Franklin. So I like this notion of using individuals, certain people in our lives or heroes of ours, for generating mental models and keeping us intellectually honest with ourselves, and maybe even using them as soundboards as well. Moving on to the investment write-up that I really enjoyed this month was Frank Taber's deep dive into Tencent. Frank is a fellow YouTuber and investor who posts a lot of great content on YouTube, but more recently has started a Substack newsletter called Seeking Value. In this write-up, Frank goes from A to Z with the history of Tencent all the way through in the individual levers that make the company tick to valuation. And at the end, he even covers some of the potential risks with the investment. So if you don't know anything about this company, this write-up should get you up to speed and thinking more holistically about this company. I think Frank's goal was to provide some context about why Tencent is potentially one of the most important and best high-quality assets in the world, not just in China, but in the entire world. More specifically, Frank gives breakdowns of all of the core pieces of the business, including their super dominant platform, WeChat, their gaming business, which is the number one gaming business by revenue in the world, the budding financial services business, their cloud computing business, and even their wonderful investment portfolio. And I'm not going to spoil it for everybody, but at the end, he gives a pretty compelling valuation for why Tencent may be a pretty attractive investment in this environment. There's also a nice portion of this write-up that is dedicated to thinking about Pony Ma as one of the greatest, or potentially the greatest, capital allocator in the history of investing. And I really love that. He uses the framework from The Outsiders, which is a book by William Thorndike that discusses some of the key attributes of the best capital allocator. And some of those traits are focusing on growing the intrinsic value per share, and general traits like having a decentralized management system like Warren Buffett and Berkshire Hathaway. So if you've heard Monish Purbai talk about the bazooka approach, where on one end we have the software businesses And on the other hand, we have the investment portfolio. Well, definitely read Frank's write-up, and you should have a much better and thorough understanding of these businesses. I'm really looking forward to continue reading Frank's write-ups. By the measure of this one, there are a lot of great things coming in the future, I'm sure. I hope you enjoyed hearing about some of my key takeaways from the resources that I was learning from in January. If you enjoyed this video and want to see me continue sharing these items every month, please let me know in the comments below, and I'll be sure to incorporate it into the regular rotation. If you enjoyed this video, you may enjoy this video over here. Thank you so much for your time. Please like the video and subscribe for more, and I will see you in the next video.